On this evening's editorial, we are joined by Sania Goff, attorney at law and president of the Pensions Industry Association in Jamaica, to share her perspectives on retirement, savings, and building generational wealth. Good evening and welcome.
Hi, Basil. How are you? Evening.
Outstanding. Please, the floor is yours.
Thank you. In Jamaica, there's often an expectation that children will make provision for parents in their older years. "Me picnic and me pension" is a phrase we hear and some of us say often. In this context, wealth accumulation by young people becomes wealth diversion, resulting in intergenerational dependence and in some cases intergenerational poverty. To the extent that one generation can effectively save for retirement so they do not look to a future generation to take care of them will help break this cycle. Encouraging younger persons to save earlier will also have positive downstream impacts for future generations. This allows for the better accumulation of generational wealth and the easing and disrupting of intergenerational dependence. One key way to prepare for retirement is to participate to the fullest extent possible in a pension plan. Whether that is the pension plan established by your employer, or if your employer does not have a pension plan or you're self-employed, by participating in any one of the independent pension products offered in the market, referred to as approved retirement schemes. And you see them advertised by NCB, GMMB, Proven. And when I say participate to the fullest extent possible, I mean to maximize the tax advantage system that allows you to contribute up to 20% of your earnings before tax to a pension arrangement. By contributing before your income is taxed, you're able to maximize your contributions as well as the returns on those contributions because all the investment earnings are tax-free. You'd only be subject to tax when you reach retirement and start to receive your pension. I'm often asked, how can someone know when they saved enough for retirement? Is there a formula? Most studies suggest aiming for a target of between 70 and 85% of pre-retirement income to maintain your lifestyle at retirement. Adequate retirement savings allows you to, at a minimum, meet your basic needs of food, shelter, and increased healthcare costs in retirement. And your typical benefit statement that's provided to you when you contribute to a pension plan will usually set up this percentage. So you can see how well you're doing against this target. And investment managers are able to help you to discuss options and best steps to improve your projected replacement rate. Another question that persons often ask is, what are the benefits of saving through a pension plan versus saving on my own? Many persons feel that they can do a better job saving on their own without going through a pension arrangement. And the truth is, it's not necessarily one or the other. Persons are encouraged to save both through a pension plan as well as personal savings. But the main advantage of a pension plan, as I mentioned earlier, is that you make your contributions before your income is taxed, and the investment returns are also not taxed. You also therefore pay less income tax as money would have been deducted for your pension contributions before tax is assessed. Also, if you're in the typical defined contribution employer pension plan, you get the benefit of your employer also making usually matching contributions on your behalf to the plan. So this is basically free money which is added to your pension pot. And then there are other benefits in terms of the ease with which your beneficiaries can receive your benefits in the event of your death. You don't have to wait for a will to be probated and all that comes with that, as well as protection from creditors. It's important to save for your retirement years because life expectancy is increasing. People are living longer and leading more active lives in retirement. Studies show that people are now living up to 2 or 3 decades in retirement. So it is important to ensure you make adequate preparations to be able to live an independent and dignified life in your retirement years. And then of course, when you retire, you experience a reduction or a complete loss of income. You may have to live entirely on what you've managed to save for your retirement years. You need to be informed, intentional, practical, and proactive in saving for your retirement. So how do we encourage more persons to save? One major way and fundamental pillar is improving financial literacy. National campaigns are important to raise awareness of ways to protect against financial risks through adequate savings, insurance, and financial education. Starting financial education in schools. People should be educated about financial matters as early as possible in their lives. And of course, making financial education a part of state welfare assistance programs. Another key way is changing choice architecture through the implementation of programs such as auto-enrollment and micro-pensions. Auto-enrollment is a program where a worker who is not in an employer pension plan is automatically placed in a retirement scheme and must make the active choice to be taken out of the scheme. The feature that makes auto-enrollment so successful is that it banks on the natural human inertia to do nothing. It does not rely on an individual to take the step to enroll in a pension arrangement, but rather puts the onus on the individual to take the step to opt out of the pension arrangement. Behavioral science supports that most persons generally do not take the step to opt out. The result in many countries who have implemented auto-enrollment is higher levels of pension savings and participation, often in the range of 50% to 70%. With private sector pension coverage hovering between 9 to 11% in Jamaica, auto-enrollment could have a significant impact. I'm proud to say that the Pension Industry Association has recently released its concept paper to propose the introduction of auto-enrollment in Jamaica. And we'll be launching a discussion series next week, continuing for the entire month of March.
Right.
Additionally, micropensions. A micropensions framework is a framework that encourages participation of low-income and informal workers. It's the concept of making very small contributions to a pension arrangement, but these contributions are made more often than you would in your traditional arrangements. So rather than monthly, you're contributing weekly. Imagine text messages that prompt you to make small contributions deducted from phone credit or possibly a linked bank account. Or perhaps at a gas station or a grocery store, you're prompted to top up or round up your payment, and that excess goes to your pension account. You don't have to think about it, and it's not burdensome. Both auto-enrollment and micropensions are examples of redesigning the traditional means of pension savings so that you no longer see retirement saving as something challenging. The heavy work is done for you. Another interesting concept that helps young members of pension plans is to allow them to make student loan payments while their employer makes contributions to their defined contribution accounts. In other words, you treat the student loan payments as if they were salary deduction contributions to the plan. This facilitates young employees building up their retirement accounts while paying down their student loans at a time when making contributions to the employer's pension plan can be financially burdensome.
Right. 30, we have 30 seconds left, and that's a lot to digest. But I'm curious, how many people are actually on such pension plans right now? Do you know the numbers? What was the percentage in Jamaica?
The percentage of what, sorry, Basil?
The percent of individuals who are actually on what you would consider a good or a stable pension plan.
Well, only about 9 to 10% of actual private sector workers. I have to kind of double check the actual number of employees, but it's very, very low in terms of overall coverage. When you add public sector workers, you get bounced up to about 18%. So coverage rates are unacceptably low in Jamaica.
Well, thank you very much. We do appreciate it. It's actually a good amount of good information. Ms. Sania Goff, thanks again.
All right, Basil, thank you.